I often like to talk about how we go through two stages in life as investors. Number one, you work for money, and number two, money works for you. Now, a lot of people wonder, am I going to have enough? Am I going to be able to retire in comfort? Am I going to be able to have enough money to do what I want to do in retirement? Work because I want to, not because I have to. Now, there are two software programs I'm going to talk about that we use here at the company to help you determine and get the answers to those questions. One, we're going to talk about how you organize your financial life, how we track things, project how much money you're likely to have based on what you have and what you're putting aside, and how much income you can take. And the other one gets really specific on how to take that income, what investment vehicles, what types of tax strategies need to be used. How do these investment vehicles affect things like Social Security or pensions that you might have access to? So let's walk through a couple of those programs and how they work. Now, the first program that we use actually walks through how you organize your financial life. Now, a lot of us have 401ks, IRAs, and we might have Roth IRAs. Sometimes you have life insurance policies and annuities and different types of accumulation vehicles. Now, these are the assets that we would have. Maybe your home is an asset. Maybe you have investment property that might be an asset. So first of all, we want to get organized in regards to what do you have, what's it invested in, and how all those accounts are funded and how much money is in those accounts. So that is where we're looking at your net worth. Then we also have liabilities because your net worth is your assets minus your liabilities. So in the first program, we have a snapshot of everything that you have and where it all sits. Now, as we're entering data into the financial plan, we need to know what your income is right now. If it's a husband and wife, his income, her income, and also income sources that will be available in the future, like pensions and Social Security. Now, what happens when we're looking at these types of income sources is we get an idea of what you're spending now as well, and get an idea of what you'll have access to in the future for spending needs. Now, another part of the first program is the cash flows section of the program. That tells us what's coming in, what are the income sources, where is money coming from. Then you have expenses, of course, so what are you spending, and also what are you saving for retirement. So we look at those three things and we look at how those cash flows change over time, because they'll change from when you are working for money to where money is working for you. We need to know where that money is coming from and how much you're going to be spending in the future. So we really set up the budget both now and in retirement. The next section of the program, we look at what's called a Monte Carlo analysis. Here's what we're dealing with when it comes to taking income from your investments in the future. The problem with stock markets, and it's a problem and it's a benefit, is that they go up and down in value. And the beauty about stock markets is the reason they have higher historic returns is because you have to put up with ups and downs. That helps protect us from inflation. But it introduces a risk in the investing process where investment vehicles go up and down in value. How do I figure out how much income I can take? If we look historically at markets, let's say I'm using large US stocks as an example, the historic long-term return of that area of the market is about 10%, going all the way back to 1926. But you will never find in any given year that the return is ever 10%. It may be up 20, down 5, up 25, down 15, up 5, down 4. It'll go back and forth, up and down in value, within a range historically. So what do we do to figure out how much income I can take? Well, what we can do is we can say, hey, what if the market conditions that occurred in 1929 are followed by the market conditions that occurred in 1955, which are followed by the market conditions that occurred in 1937. And the market conditions after that were the ones that happened in 2007. Well, what if we just randomize them? In the Monte Carlo analysis, we literally take an investment portfolio with a known expected return and a known standard deviation or amount of volatility that we might expect looking at history, and we literally randomize it. We will show different returns in different orders, and this is what we call stress testing your investment portfolio to determine whether, based on how it's invested, is it likely to give you an outcome that is going to be favorable in retirement. Will I be able to take income from this portfolio without worrying about running out? So you'll see these graphs. And these graphs actually show you what the range of expected returns could be. And what that gives us an idea of is how much income you're going to be able to take. It's also going to give us an idea if you're likely to be able to leave an inheritance for somebody, and whether you're likely to run out, and make sure that we actually rearrange the investment portfolio and the income streams so that you don't end up in a precarious position. You don't want to live under a bridge in retirement. And this helps us determine whether you're going to be okay in retirement. It's a beautiful process to help us really determine, is the plan going to work? Now, the next really popular feature of the software program that we use is a vault. And what this allows us to do is take really important documents and store it in one place so that you can get access to it at any point in time. Now, this is really important because at some point we're not going to be around anymore, and there are going to be heirs trying to figure out what do you have and making sure that they know what to do with what you have and settle an estate. Now, this is also nice for another reason. You can have your will stored there. You can have tax returns stored there if you'd like to keep that there. You can have different estate documents like medical directives and living wills and living trusts and things like that all in one spot. Now, this is really handy because if you've ever been admitted to a hospital, typically what's the first thing that they want? They want to know whether you have a living will or medical directives so that if something goes wrong, they know whether there's a need to resuscitate, whether you want to be kept on life support, really important decisions like that. And also, you can store documents such as durable powers of attorney. You may need somebody to make decisions on your behalf if you're not able to make those decisions. Now, it's really nice to be able to pull out a smartphone when they ask you that question, do you have any of these documents? And you can go, yep, here they are right here. Right at your fingertips, and you can organize it all in one place. One of the other aspects of the programs that we use in planning is this income feature in retirement. Now, what we're doing here is we're looking at what's the most tax-efficient way to get through retirement if taxes are really important to you, and what is a way that we can make sure that we make the most of what you have accumulated. Let me give you an example to help clarify this some. Required minimum distributions are typically started at age 72. So let's say that you have a pre-tax plan like a 401k or an IRA. The government has never gotten any money on this money that you've accumulated. You took a tax deduction when you put the money there. It grew without taxes. Now it has to be taxed on the back end. So you're looking at this program and going, well, I got to pay taxes on this at some time. And when you hit 72, they're going to have you start taking distributions. Is there anything I can do to reduce the amount of distributions and reduce, hence, the amount of taxes that they pay? Well, yeah, a lot of times there are. Let's say that you retire at age 65 and you decide you're going to take your Social Security at age 70. And you have a non-qualified account. Well, we can actually model this. We can look at it and say, well, what if you live over the next 5 years off of some of that money in your non-qualified account, which the tax rate will be extremely low because this is after-tax money. Then that allows us to take some of the pre-tax money, convert it to Roth IRAs, hence they will never be taxed again ever. That reduces the IRA account value and reduces the required minimum distributions later. Why is that important? Well, it's not only important for tax reasons on the IRA, it also can reduce the taxation on your Social Security benefits. So it can be really important and give the financial plan even a better shot of being successful. And for some people, they just don't like paying taxes, so this is a really fun part for them. Now, the other thing we can do is this. We can also look at it and say, hey, are you a person that really wants to leave a legacy? Well, you may want to order the arrangement and how you take income in a different way than a person that may say, no, I want my last check to bounce and I'm not worried about leaving a bunch of money. And you may be a person that happens to be in the middle. It will literally kick out 40 different scenarios, and we can choose between those based on what your goals are to determine which way of taking income in retirement is best for you. A really powerful part of this program. So as you can see, the retirement planning process is full of complexity. Changes in markets, changes in tax laws, and changes in goals or changes in other benefit programs that you have access to. How do we model all of this? How do we put all this together? These programs can be absolutely critical to doing all of this. Now, this isn't just something that you do once. We do this on an ongoing basis because we got to make sure that you're on track for your retirement. We know how much income you have. We know what the investments are. We update this constantly in the program, and we also update it on a regular basis throughout your retirement as tax laws change, as things change in your life. Maybe your goals change. Maybe some of the things that you have going on in your life are different from what they were when you first retire. So we don't just set it and forget it. This is something we do on an ongoing basis. And what we find with clients is this. When they go through this process, it is a great stress reliever because they, for maybe the first time in their entire lives, know exactly what they're doing, why, and what to expect. Financial planning process is tremendously beneficial for helping people have less stress in retirement.